Hey everyone, Medical Properties Trust offers investors a dividend yield of 17.5%. Now, I know passive income investors get excited when they see a dividend yield that high, but as is usually the case, when a dividend stock has a dividend yield this high, there is some troubles within the company. So in this video, I'm going to dig deeper into Medical Properties Trust, look at its dividend, look at its ability to pay the dividend, and answer if this dividend yield is safe for passive income investors. So let's dig deeper and look at our analysis.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so to get my dividend yield of 17.5%, I took Medical Properties Trust latest quarterly dividend per share of 15 cents. I annualize it by multiplying it by 4 and divide it by the market price per share of $3.43 to give me my dividend yield of 17.5%. Now, Medical Properties Trust recently decreased their dividend payment. On February 16, 2023, they had a dividend per share of 29 cents. And then again in April 27, they reiterated that dividend of 29 cents. Then on August 21st, management finally thought it would be prudent to decrease their dividend per share down to 15 cents, given the issues that the company is facing. And this is the dividend I'm assuming is going to be the case for the next few quarters, the next 4 quarters. Maybe they increase their dividend again later on once their issues are resolved. But for now, I'm assuming that their dividend per share stays at 15 cents. One of the issues that they're having is difficulty with their tenants. Their tenants are having difficulty and they're not making their full rent payments. And so that's giving Medical Properties Trust difficulty generating its usual amount of cash flow. However, the good news is that Prospect, one of its bigger tenants, will begin making full rent payments on its approximately $513 million California portfolio at a mid 8% cash rate in March of 2024. So in just a few months, one of its bigger tenants is expected to resume making payments. Although if I was a passive income investor, rather than relying on this, I may wait and see that dividend, that payment actually come through before I feel confident that this is indeed what's going to happen. So I'm more of a wait and see kind of investor, especially in troubled situations. I'm more of a wait and see. In more reliable, more consistent situations, we can pretty much take the word of management in what's about to happen because things have been happening in that way. There's no reason to expect any difficulty. But when there's already difficulty, then I'm more of a wait and see before going in and trusting these expectations going forward. After all, it's only a couple of months. As an investor, as a dividend investor, I would wait and see before I feel confident that they are indeed going to resume these payments in March. So one other thing that I look at when I'm judging a dividend safety or the safety of a dividend is the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable, because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example, where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term, unless the company can expand its earnings per share in a relatively short amount of time. So now that we understand the dividend payout ratio a little bit more, let's take a look at Medical Properties Trust. In the purple, you have its dividend per share, which held consistent until the recent decrease, right, from the 29 cents down to the 15 cents. And what you noticed is, for a while, its earnings per share were well above its dividend per share. However, since its earnings per share had decreased starting in late 2022, it had been several quarters in a row where its dividend per share was above its earnings per share. And that's why you can understand why Medical Properties Trust decreased its dividend per share in the latest quarter. And you can see strategically it was below its earnings per share in that quarter. So in its latest quarter, it paid a dividend per share, of 15 cents, while it generated an earnings per share of 19 cents. So its payout ratio was less than 100%. However, it was still really close. And given the fluctuations of its earnings per share, it's still in danger of exceeding dividend per share. Now, before everyone starts yelling at me in the comment section that when you're looking at a real estate investment trust, you need to look at the funds from operations and not earnings per share, I understand that. I'm going to look at that as well. But to simplify things, I just wanted to take the dividend per share and earnings per share and look at it on a simplified basis before we get into its funds from operations, which is a more informative ratio or number to look at when you're evaluating real estate investment trusts like Medical Properties. And looking at this metric, their FFO per share of 34.7 cents in the most recent quarter was comfortably above the dividend per share of 15 cents in the most recent quarter, although this figure too has been fluctuating after jumping and falling, and the issues with its tenants will continue to weigh on these numbers. Now, if that tenant that is expected to resume payment in March actually does so, that would go a long way in helping Medical Properties Trust increasing its funds from operations. Now, sometimes companies can pay their dividend by borrowing or using their savings, but I don't think Medical Properties Trust has much room in this regard. It has $10 billion in long-term debt and $340 million in cash and short-term investments. Yes, real estate companies, REITs, are typically leveraged, but this is already high leverage. I wouldn't expect them, and you can understand they already cut their dividend because they're already leveraged pretty significantly. They don't want to go into even more debt in order to support their dividend payment, which is why they cut their dividend payment initially to begin with. All that being said, Medical Properties Trust stock is relatively cheap. It's trading at a forward price to earnings of just 4. The cheapest this stock has been, according to this metric, going all the way back to 2020. So, as a passive income investor, if you're willing to look at this stock holistically and not just zoomed in on the dividend, then it could make a good investment because you're getting the stock at a bargain value. But you have to realize that the dividend may be cut even more. They might cut that dividend per share even more. That dividend, that 17.5% dividend, I'm sorry to say, is not safe. It's not a reliable dividend where you can say, all right, I'm going to buy this stock. I'm going to rely on this dividend for the next 5, 10, 15 years. That's not going to be the case here. That's not my opinion of safety in this case. However, if you're willing to look at this investment holistically, you may be able to buy this stock, and while the dividend may decrease, your total return over the next 5 years might still be solid if you're willing to look at a capital gains yield in addition to a dividend yield. So the dividend yield itself, not very safe. The stock overall might be a good investment for passive income investors. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.